Welcome. I am the options Overlord, and this is how to trade the long call. This is the one strategy on this channel where you buy premium instead of selling it. Directional leverage with strictly defined risk. It is powerful and it is a step up, so I'm going to be honest about both sides. Let us get to work. First, the ground rules. Everything here is education, not personalized financial advice. Options carry substantial risk. They are not for everyone, and you can lose money. The data I show is believed reliable, but comes with no guarantee. Do your own research, speak to a licensed advisor, and own your decisions. Good, now let us trade. What is a long call? You buy the right, not the obligation, to purchase 100 shares at a set strike before expiration. You pay a debit up front, and that debit is your absolute maximum risk. Three things define it. Your maximum loss is the premium, never more. Your upside is theoretically unlimited above break-even, and it is leveraged. You control 100 shares for a fraction of the cost of owning them. But hear this, unlike a covered call, a long call can lose 100% of its premium. This is a step up, never your first trade. The mechanic, 4 steps. 1. Pick a stock and a direction. Strong bullish conviction, ideally a breakout on volume. 2. Buy the call. In the money strikes, 0.70 to 0.80 delta are preferred for stock replacement. 3. Pay the debit. Your account is charged the full premium, and that is your maximum risk. 4. Manage and exit. Profit as the stock rises above break-even and sell the call back before expiration. Never hold an out-of-the-money call to expiry. Let us make it real. A mega cap tech name at 150. You buy the 145 call in the money at a 0.75 delta, 60 days out for $8. That is $800. And here is the difference from every other video on this channel. That $800 goes out, it is debit, and it is your maximum loss. Your break even is 153, the strike plus the premium. Above that, your upside is unlimited. Below 145, the call expires worthless. The cash leaves up front, and now time decay is working against you, not for you. Look at the payoff. Below 145, you are flat at your maximum loss, $800, no further. Your break even is 153, and above it, every dollar adds 100 per contract, unlimited. If the stock hits 175, your $800 call is worth $3,000, a 275% return. That is the appeal. But that loss floor is real, and you reach it at any time the stock simply fails to move. 2 outcomes. Scenario 1, the stock surges. It closes at 165. Your 145 call is worth $20, $2,000, and you sell to close for a $1,200 profit, 150%. In practice, sell before expiration to capture any remaining time value. Scenario 2, it stalls or falls. Theta erodes the premium daily. At 150, the call is worth just $5, intrinsic only. Below 145, it expires worthless, and your loss is the full $800. Never hold a losing call to expiry. When to use a long call? When you have strong bullish conviction, a fast, aggressive move, you must be right on direction, size, and timing. When implied volatility is low, IV rank below 30, so you buy cheap. As a stock replacement, in the money calls capture upside for a fraction of the capital. On a technical breakout, momentum already working for you. And avoid earnings with short-dated calls. Even a right call gets wiped by the volatility crush. One more, and it matters. This is the inverse of selling. As a buyer, you want low IV and a fast move. Sellers want high IV and time. Know which side you are on. The risks, and they are different here. Theta is your enemy. Every day the call loses value. The stock must rise faster than time decays. Your maximum loss is defined, capped at the debit. The Vega trap, if you buy when IV is high and it drops, the call loses value even if the stock rises. Massive leverage about 18 times and it cuts both ways. You must be right on direction, size and timing. 2 out of 3 is still a loss. And check IV rank before you buy. Above 50 you are overpaying and gains or losses are taxable. Treatment varies. Get local advice. 6 best practices. Buy time, 60 to 90 days. Stop buying weekly lottery tickets. Buy in the money, 0.70 to 0.80 delta. The Overlord sweet spot. Less extrinsic value to decay. Avoid out-of-the-money calls. They are lottery tickets that theta destroys. Take profits at 30 to 50%. A fast gain in the first week or two, take it. Always check IV rank first, above 50, wait or use a debit spread. And the 50% loss stop. Never let a long call lose more than half its premium. If it halves, close it. A level deeper, 2 dials, delta. How far the option moves per dollar and the odds of finishing in the money. 0.10 to 0.20 are lottery tickets. 0.50 is at the money and decays fast. 0.70 to 0.80 is the sweet spot. In the money, moving nearly 1 for 1. And volatility, the buyer's view, you want it low. Cheap premium now with room to expand. IV rank below 30 is the ideal entry. Above 50, you are overpaying. Single name IV often mean reverts faster than the VIX, so screen for low IV even when the market looks jumpy. Managing it, taking profits, the profit floor, close at 50%, bought for 800, the stock runs to 156, the call is about 1200, sell for a $400 gain. Theta is accelerating, and the free trade, if you hold 2 contracts, sell one at 100% to recover your full cost. The rest is a free ride. Cutting losses, the 50% stop. If that $800 call drops to 400, close it, and the time stop. No move your way in the first 30 days of a 60-day call, close it. Never hold a loser into the final week. Rolling. When the thesis holds but time or price has moved, roll out, selling the expiring call and buy the same strike further out. Pay a debit, keep the position. Roll up after a surge, sell the in-the-money call for a gain and buy a higher strike. Pull cash, keep upside, or close and redeploy. Sometimes the best roll is none. Here is a rollout example. Your 145 call with 10 days left still has conviction but no time. You sell it for 600, buy the 60-day 145 for $8.50, a $250 debit for 60 more days at the same strike. 6 mistakes. Earning lottery tickets, short-dated calls into earnings. The crush wipes them out. Holding to expiration. If it is out of the money in the final week, sell for whatever remains. Ignoring the rule break-even, pros look at strike plus premium. Your 145 call needs 153 to profit. Buying out of the money for the big score, the classic retail mistake. Probability of profit below 30%. Buying in high IV, overpaying for intrinsic value. And no exit plan. Know your profit exit, your loss stop, and your time stop. No plan is gambling. Quick glossary. Long call, strike price, premium or net debit, intrinsic value, extrinsic value, theta, delta, and break even. Pause here if you want them to stick. The 2 to hold on to, your debit is your maximum loss, and intrinsic value is the part that decays. So in the money calls, which are mostly intrinsic, lose value far more slowly. So after the long call, you control a large position for a fraction of the capital to own shares. You define your risk to the exact penny you pay and never more. And you build the edge by mastering delta and giving yourself time. Educate, discipline, execute. Where to go next? Watch the covered call video, the exact counterpoint to this one, where you sell premium instead of buying it. Go deeper in the Overlord's covered call playbook, 3 stages, 9 steps, and use code YT100 for $100 off. And stay current with the weekly US market updates. Thank you and good luck with your trading. I am the Options Overlord. Educate, discipline, execute.